Fears over Greenland and a possible tariff war launched by the US against European NATO allies that don't toe the line, according to US President Donald Trump. Those have dissipated. Now the focus is on earnings. We are joined by Garrett Melson, portfolio strategist at Natixis Investment Managers Solutions. Garrett, great to see you. Thank you very much indeed for joining us. What themes are you looking out for in the current earnings season?
Yeah, well, I think time and time again, we see that corporate America can deliver, and they continue to drive solid top-line growth, and more importantly, I think, expand margins. And that's been a big reason why you've seen the resilience in markets over the last couple of years. And I think a big reason as to why you continue to see multiples grind higher, even though we hear all the time that markets are expensive. These are high-margin businesses, and higher margins and higher quality businesses demand higher multiples. So I think that's the underlying theme here. So far, it's still somewhat early in the season. We're just getting into the heart of it this week. Top line and bottom line beats are pretty solid, maybe a little bit softer than the prior quarter, but we did come into the quarter with pretty elevated expectations. You didn't see that typical downgrade or downward revision cycle to the same magnitude you normally did. So you could argue that the bar is maybe a little bit higher, but so far, a lot of the reports we've seen have been pretty decent. The bigger point we're watching for, though, is the price reaction, and that's been fairly weak. Again, still kind of early in the season here, but something we'll be keeping a close eye on, as the reaction to the news generally matters a lot more than the news itself.
Sorry, you mean reaction to earnings, surprises or projections, whether bullish or bearish?
Exactly. It's the reaction to the news is what gives you a sense in terms of where expectations lie, what is actually priced in, and that's really the key to identifying opportunities in the marketplace here. So something we're keeping an eye on closely. I think the last I looked, we're at basically the weakest price reaction for double beats, so beating on the top and the bottom line since 2000. So again, it's still early, and you have to keep in mind we've been on a pretty solid run in here, certainly in the market pricing in this re-acceleration narrative here domestically in the US. But again, it gives you a sense as to what's priced in, and it certainly seems like a lot of optimism is already priced in at these levels.
We've heard a lot about, small caps are going to have their day in the sun. And we did see the Russell 2000 hit a record high not so long ago. But your bias is still large cap?
It is. And, I think it's an environment where, at least right now with the current narrative, small caps can probably continue to run. If you really think about what drives the small cap trade, it's kind of three elements, right? It's going to be that valuation discount. That certainly has been in place for quite some time. So you can check that box. The other two boil down basically to the rate backdrop and financial conditions, and then the growth side of things. I think it's pretty clear that you've seen a pretty material easing in financial conditions. And yes, we've walked back some expectations of cuts for this year, and certainly pushed out the next rate cut, basically into June or July of this year. But the expectation is that the easing bias is still intact from the Fed. So the real question mark boils down to the growth outlook. And in our view, I think the consensus is getting a little bit over sanguine on just how robust growth will be this year. We think it will be decent, but I don't know it will be enough to really drive a significant and durable bout of outperformance for small caps. So we'd be looking for a little bit of maybe another false start in here, something akin to what we've seen a number of times over the last couple of years here, until we get clear signs that indeed that easing bias is intact and growth is really durably on the rise here, not just driven by a one-off fiscal impulse in the first quarter thanks to tax cuts.
You're neutral on tech, and you are in the camp that says people should maybe put less emphasis on companies that benefit from huge capex spending on AI computing power.
Actually, I'd argue I think that's where there's still some opportunity. So the AI capex beneficiaries are probably going to continue benefiting from what we know is still a large capex spend this year. We already have kind of the capex plans from the Mag 7. But to your point, I think the reason to be maybe more neutral on tech and maybe the broader growth complex is because growth is actually holding up okay. And that tends to be a decent backdrop for solid nominal GDP growth. And that tends to support pretty decent revenues and earnings growth. So I think that does help to maybe push this idea of a broadening out and maybe a little bit of a catch up and outperformance for the value portion of the market, and namely led by cyclicals. But I think the big story is that monolithic AI trade certainly has broken down, and you've seen the market is rewarding winners within the hyperscaler space and starting to punish some of those relative losers. And I think that creates this tension where you have a tug of war in some of those bigger weights in the indices. That might open up the opportunity for other sectors to lead, and then also the opportunity for some of those AI CapEx beneficiaries that are maybe more represented by equal weighted tech to start to carry the leadership in here, as opposed to the Mag 7 that we've grown accustomed to over the last couple of years.
And what sort of companies tend to be winners from AI CapEx? What type of industry?
Yeah, I think it's still obviously within the tech space more broadly. So if you think of those feeders into the data center build out, those are going to be areas that continue, I think, to generate returns in here, just because they're, one company's CapEx spend from the hyperscalers is another company's bottom line and earnings. So I think that's going to continue to be the story, those feeders into the data center build out here. But you can extrapolate that a little bit more broadly outside of tech as well. If you think about materials, so obviously been on a very strong run in here, but obviously a key source of demand for data centers. But also, if you think about shifts in the geopolitical and global stage, you are seeing maybe this shift in terms of more defense spending, and that's going to be a demand in terms of those same materials here, and then more broadly in the industrial space. So a lot of these feeders into the AI build out, but also if you expand it a little bit more broadly, there's kind of these multi-dimensional sources of demand that help to drive earnings growth and potentially multiple expansion more broadly in that cyclical complex as well.
Emerging markets, you see promise in, and of course the US dollar now near a 4-year low against other big world currencies. Is that good for emerging markets, generally speaking?
Yeah, that's a key point to keep an eye on here. We've certainly seen a little bit of a shift in sentiment around the dollar over the last week or so. Obviously, action around the Japanese yen is driving some of that. But if you look at more broadly against major currencies and even EM currencies, you're seeing some pretty broad weakness for the dollar, basically breaking down to new 52-week highs. So certainly a new impulse for the dollar to weaken here. That tends to be supportive of easing financial conditions, and that tends to be supportive of EM economies as well. So I think a good environment in here for EM just from the dollar and financial conditions perspective. But global growth is doing okay as well in here. And so I think if you just look at it against that backdrop, an environment where financial conditions are easing and global growth is doing okay, that tends to beget pretty solid performance for EM economies. And I think that's going to be a theme for this year that continues.
And what about interest rates broadly in the United States? Well, what is your view there? I'm thinking in particular the 10-year bond yield as a measure of funding costs for companies, for example.
Yeah, absolutely. I think we're kind of settling into this environment where all those wild oscillations over the last couple of years, they've been compressing. And you can see that really reflected in the MOVE index, which just continues to grind lower. So implied volatility in the bond market is certainly compressing here. And I think that's reflective of the fact that trading range for 10s is basically narrowing. So if I were to kind of throw out a range there, maybe 4 to 4.5% feels about right. Give a little bit of room for an overshoot with narrative. So on the upside, maybe this no landing is kind of coming back into the lingo here in the marketplace. That could maybe drive a little bit of incremental upside on 10s, but I think the bigger risk for an overshoot would probably be to the downside if you really don't see that huge fiscal impulse that I think the narrative is pricing in right now, and put that together with continued cooling in the labor market, which seems to be a lot of investors are somewhat glossing over and pricing in a little bit of a stabilization to even strengthening in the labor markets. If that doesn't pan out, then I think you could see potentially a little bit of a narrative reset and push 10s a little bit lower. But for me, I think the big story is it's turning into basically a carry trade, and a carry trade from nominal and real yields that are pretty attractive in here when you think about where we've been over the last 15, 20 years.
Garrett, thank you very much indeed.
Thanks for having me.
Garrett Melson, portfolio strategist at Natixis Investment Managers Solutions.